Come to our comprehensive overview of miscellaneous provision under the Companies Act 2013. In this video, we'll explore crucial aspects such as registered valuers, removal of company names from the register, government company, NIDHIS, DOM company, and various penalties and compliance requirements. By the end, you'll have a clear understanding of these often overlooked but essential rules that impact company operations and compliance. Let's begin by setting the context. Ministry of Corporate Affairs has introduced several notifications, especially in December 2016, which brought significant amendments to the Companies Act 2013. Additionally, the enforcement of the Insolvency and Bankruptcy Code 2016 has led to substantial changes in how companies are regulated. These updates ensure that the legal framework remains robust and relevant to the evolving business environment. Understanding these changes is crucial. Registered valuers play a pivotal role in the corporate world, ensuring that assets are valued accurately and impartially. Section 247 of the Companies Act 2013, along with the Registered Valuers and Valuation Rule 2017, governs their appointment, roles and responsibility. Valuation is required for various assets, including property, stocks, shares, debentures, goodwill, and even company liability. The process is designed to maintain transparency. Appointment of a registered valuer must be done by someone with the necessary qualifications and experience, who is also a member of a recognized valuers organization. Typically, the audit committee appoints the valuer, or, in its absence, the board of directors. This ensures that the process is both rigorous and impartial, reducing the risk of conflicts of interest and maintaining the integrity of valuation. Valuers are required to provide impartial, true, and fair valuations of assets. They must exercise due diligence, follow prescribed rules, and avoid valuing assets in which they have a direct or indirect interest for 3 years before or after their appointment. This strict code of conduct ensures that valuations are reliable and free from bias, which is critical for stakeholders relying on these reports. If a registered valuer contravenes the provisions or rules, they face a penalty of 50,000 rupees. If the contravention is with intent to defraud, the punishment can include imprisonment up to 1 year and a fine between 1 lakh and 5 lakhs. Additionally, convicted valuers must refund their remuneration and compensate for any losses caused by misleading statements in their report. Company Registered Valuers and Valuation Rule 2017 apply to the valuation of property, stocks, shares, security, goodwill, and other assets or liability. These rules define key terms such as asset class, certificate of recognition, registered valuers organization, and valuation standard. Understanding these definitions is essential for compliance and for anyone involved in valuation activity. Become a registered valuer. An individual must be a member of a recognized valuers organization, possess the required educational qualifications and experience, and pass the valuation examination. Additional criteria include being a resident of India, not being a minor, not being bankrupt, and having a clean legal record. Companies and partnership entities must also meet specific eligibility requirements, ensuring only qualified and reputable professionals. Individuals seeking registration as a valuer must have a postgraduate degree with at least 3 years of relevant experience, or a bachelor's degree with 5 years of experience, or be a member of a professional institute with 3 years experience. The discipline must be relevant to the asset class being valued. This ensures that valuers have both theoretical knowledge and practical expertise. Valuation examination is conducted by the authority or a designated agency and tests knowledge, skills, values, and ethics related to valuation. The syllabus, format, and qualifying marks are published on the authority's website. Individuals can attempt the exam multiple times, and passing it is a key step toward becoming a registered valuer. Obtain a certificate of registration. Eligible individuals and entities must apply to the authority using the prescribed form and pay the required fees. The authority reviews applications, may request additional documents, and can require personal appearances for clarification. If satisfied, the authority grants registration within 60 days, excluding time taken for additional information or clarification. Registered valuers must maintain eligibility, comply with all relevant laws and regulations, and only value asset classes for which they are registered. They must also handle grievances, maintain records for at least 3 years, and follow the code of conduct of their valuers organization. For partnership entities and companies, only qualified partners or directors can sign valuation reports. Registered valuers must promptly inform the authority of any changes in personal detail, composition of partners or directors, or any modifications that may affect their registration. This ensures that the authority always has up-to-date information and can maintain the integrity of the register of valuers. Registered valuers must comply with notified valuation standards, or, until such standards are notified, use internationally accepted standards or those adopted by their valuers organization. Valuation reports must include background information, purpose, identity of valuers, disclosures of interest, dates, procedures, and any limitation. This comprehensive reporting ensures transparency and accountability. Registered valuer may temporarily surrender their registration in accordance with the bylaws of their valuer's organization. Both the valuer and the organization must inform the authority about the surrender or revival of membership. Details of such changes are made publicly available on the organization's website, ensuring transparency for all stakeholders. Organizations can be recognized as registered valuers organizations if they meet specific requirements, such as being registered under Section R of the Companies Act or as a professional institute. They must conduct educational courses, grant membership, enforce a code of conduct, provide continuing education, and have mechanisms for grievance redressal and disciplinary proceeding. Complaints against registered valuers or their organizations can be filed with the authority, accompanied by a nominal fee. The authority examines complaints and may refer them to the relevant valuer's organization for action. This process ensures accountability and upholds professional standards within the valuation industry. Central government notifies and may modify valuation standards based on recommendations from a committee comprising experts from various fields, including finance, law, and accountancy. The committee's diverse representation ensures that standards are comprehensive and reflect industry best practices. Anyone contravening the valuation rules faces penalty as per Section 469(3) of the Act. Making false statements in reports or certificates can lead to prosecution under Section 448. These provisions deter misconduct and protect the interests of companies and stakeholders relying on accurate valuation. Companies Act 2013 provides detailed procedures for removing company names from the register. The registrar can initiate removal if a company fails to commence business, is inactive for 2 years, or hasn't paid subscription money. Companies can also apply for removal after extinguishing liability and obtaining necessary approval. These provisions help maintain an updated and accurate register of active company. Registrar can remove a company's name if it hasn't started business within a year, is inactive for 2 years, or hasn't paid subscription money. A notice is sent to the company and its directors, giving them 30 days to respond. After considering representation, the registrar may strike off the name, ensuring due process and fairness. Companies can apply for removal of their name from the register after settling all liability, passing a special resolution, or obtaining consent from the petition of members. If regulated under a special act, approval from the relevant regulatory body must be obtained. This process ensures that only companies meeting all requirements can exit the register. Section 201 restricts companies from applying for removal if, in the previous 3 months, they changed their name, shifted registered office, disposed of property, engaged in non-essential activity, applied for compromise, or are being wound up. Violating these restrictions can result in fines and rejection of the application, ensuring that removal is not used to evade responsibility. Once a company is dissolved under Section 248, it ceases to operate and its certificate of incorporation is cancelled. However, the company continues to exist for the purpose of settling liabilities and obligations. This ensures that creditors and other stakeholders can still recover dues even after dissolution. If a company applies for removal with the intent to evade liability or defraud creditors, those responsible are jointly and severally liable for any resulting losses and are punishable for fraud under Section 447. The registrar can also recommend prosecution, reinforcing the seriousness of fraudulent action. Any person aggrieved by the registrar's order to dissolve a company can appeal to the tribunal within 3 years. The tribunal may restore the company's name if it finds the removal unjustified. The process ensures that companies have recourse if they believe their removal was in error or based on incorrect information. If the tribunal orders restoration, the company must file the order with the registrar within 30 days. The registrar then restores the company's name and issues a fresh certificate of incorporation. This process helps companies regain their legal status and continue operation if justified. Government company is one where at least 51% of the paid-up share capital is held by the central or state government, or both. This includes subsidiaries of such company. The definition is important for determining compliance requirements and the preparation of annual reports. Section 394 requires that government companies prepare annual reports within 3 months of their annual general meeting. These reports, along with audit comments, must be laid before Parliament or state legislature, depending on the ownership structure. This ensures transparency and accountability in the functioning of government company. Nidhai, or Mutual Benefit Society, is a company declared as such by the central government. Its main objective is to cultivate thrift and savings among members, accepting deposits and lending only to its members. Nidhais are governed by specific rules that ensure their operation remain focused on mutual benefit and financial prudence. Nidhai Rules 2014, as amended, apply to all companies declared as Nidhais or functioning as such. Key definitions include net owned funds, standard assets, non-performing assets, and more. These rules provide a clear framework for the formation, operation, and regulation of Nidhai company. Nidhai must be a public company with a minimum paid-up equity share capital of 10 lakh rupees. Existing Nidhais must comply with this requirement within 18 months of the 2022 amendment. Nidhais cannot issue preference shares after the commencement of the Act, and their primary object must be mutual benefit among members. Nidhais must have at least 200 members within 1 year of incorporation and maintain a net owned funds to deposits ratio not exceeding 8:1. Only individuals can be members. Bodies, corporate, and trust are excluded. Members must hold a minimum number of shares, and minors can only have deposits through guardian. Nidhais are prohibited from engaging in chit fund, hire purchase, leasing, insurance, or acquiring securities of other company. They cannot accept deposits or lend to non-members, pledge members' assets, or pay brokerage for mobilizing deposits. These restrictions ensure that Nidhais remain focused on their core mission of mutual benefit. Nidhais can accept deposits up to 20 times their net owned fund and must maintain unencumbered term deposits of at least 10% of outstanding deposits. Loans can only be given to members, with limits based on the company's deposit base. Loans must be secured against gold, property, or government security, and interest rates are capped. Directors of Nidhais must be members and can serve up to 10 consecutive years with a 2-year gap before reappointment. Auditors can serve for 1 term of 5 years, individual, or 2 terms firm. These rules promote good governance and prevent concentration of power. Nidhais must file half-yearly returns and obtain an annual auditor's certificate confirming compliance with all rules. Non-compliance can result in fine, and persistent violations may lead to further penalty. These requirements ensure ongoing transparency and regulatory oversight. Dormant company is one form for a future project or to hold assets or intellectual property with no significant accounting transaction. Inactive company, which haven't operated or filed returns for 2 years, can also apply for dormant status. This status helps companies maintain legal existence without full compliance burden. To obtain dormant status, a company must pass a special resolution or obtain consent from 3/4 of shareholders. The application is made in Form MSCA and the registrar issues a certificate if satisfied. Dormant companies must have a minimum number of directors and file annual returns to retain their status. Company is eligible for dormant status only if there are no ongoing inspection, inquiry, prosecution, or outstanding public deposits or loans. There must be no disputes in management, and all statutory dues must be cleared. These conditions ensure that only compliant and non-controversial companies can become dormant. Dormant companies must file an annual return in Form MSC-13 and pay the prescribed fee. They must also notify the registrar of any changes in directors or share allotments. Failure to comply can result in the loss of dormant status and removal from the register. Dormant company can apply to become active by filing Form MSC-4 and submitting the required documents and fees. The registrar reviews the application and, if satisfied, issues a certificate in Form MSC-5. Companies must ensure compliance with all requirements before seeking active status. Section 447 of the Companies Act prescribes strict punishments for fraud. If the fraud involves at least 10 lakh rupees or 1% of turnover, the guilty party faces imprisonment of 6 to 10 years and a fine up to 3 times the amount involved. If public interest is affected, the minimum imprisonment is 3 years. Lesser frauds can still result in up to 5 years imprisonment or a fine up to 50 lakh rupee. Section 450 applies when no specific penalty is provided elsewhere in the Act. The company and its officers are liable to a penalty of 10,000 rupees with an additional 1,000 rupees per day for continuing contravention, subject to maximum limits. This ensures that all violations, even minor ones, are addressed. Summary: the Companies Act 2013 provides a robust framework for valuers, company dissolution, government company, Nidhais, dormant company, and penalties for non-compliance and fraud. Understanding these provisions is essential for company directors, professionals, and stakeholders to ensure compliance and protect their interests. Stay informed and consult experts when in doubt to navigate the complexities of corporate law effectively.